Look at a chart of the S&P 500 over the last 100 years. It goes up and to the right. We assume this is because of innovation or technology or capitalism. But the smart money knows the real secret engine of growth: babies. For a century, every generation was larger than the one before it. More workers, more consumers, more taxpayers. It was a pyramid scheme that worked because the base kept getting wider. But in 2025, the pyramid has inverted. We have hit peak human. Fertility rates across the developed world have collapsed below replacement level. South Korea is at 0.7. China has halved its birth rate in 7 years. Even the US is below the break-even line. This isn't just a social issue. It is a mathematical catastrophe for the stock market. An economy with fewer people cannot grow. It shrinks. We are walking into the silver tsunami, a world where the old outnumber the young, and the bills are coming due just as the payers are disappearing. To understand the severity of this crash, you have to look at one specific ratio: the dependency ratio. This measures how many working-age people who pay taxes exist to support one retiree who consumes taxes. In 1950, when Social Security was young, there were 16 workers for every one retiree. The burden was light. Today in the US, there are fewer than 3 workers per retiree. By 2035, it will be closer to 2. In parts of Europe and Japan, it is already approaching 1-to-1. Think about the physics of that economy. Imagine you go to work and half of your paycheck is immediately confiscated to pay for the pension and health care of someone who is no longer working. That is the tax rate required to keep the promises we made. Politicians won't say this out loud. They will talk about adjustments. But the smart money knows the truth. The math is broken. The promises cannot be kept in real dollars. Let's call Social Security and Medicare what they mathematically are: a Ponzi scheme. I don't say that to be provocative. I say it to be precise. In a Ponzi scheme, you use the money from new investors to pay the old investors. Social Security uses the taxes from new workers to pay current retirees. There is no lockbox. The money you paid in 20 years ago is gone. It was spent on road, wars, and grandpa's checks in 1990. So what happens when you run out of new investors? The scheme collapses. The Social Security Trust Fund is projected to be insolvent by the early 2030s. At that point, by law, benefits must be cut by 20 to 25%. Will any politician allow grandma's check to be cut by 25%? Absolutely not. It is political suicide. So what will they do? Refer back to Case File 03. They will print the difference. They will turn the pension crisis into an inflation crisis. The government will issue trillions in new debt to fill the hole, debasing the currency to keep the nominal checks flowing. There is a second consequence to the silver tsunami that Wall Street is just waking up to: structural inflation. For the last 40 years, we lived in a world of abundant labor. The baby boomers were working. China joined the global economy. Workers were everywhere. Labor was cheap. This kept inflation low. That era is over. The boomers are retiring en masse. China's workforce is shrinking by millions every year. We are entering an era of labor scarcity. When labor is scarce, wages go up. When wages go up, companies raise prices. When prices go up, workers demand higher wages. This is the wage price spiral. If you are waiting for inflation to go back to 2% and stay there, you are betting against demographics. A shrinking workforce is inherently inflationary. The smart money is positioning for a world where good help isn't just hard to find, it is structurally expensive forever. Now let's look at the sector that will consume the economy: healthcare. As you age, your consumption patterns change. You stop buying houses and cars. You start buying knee replacements, insulin, and assisted living. An 85-year-old consumes 5 to 10 times more healthcare resources than a 30-year-old. We are about to have the largest cohort of 85-year-olds in human history, but we do not have the doctors, nurses, or caregivers to look after them. We are facing a supply shock: no doctors; meeting a demand shock: millions of seniors. This means the cost of care is going to hyperinflate. The smart money is looking at this and seeing a grim reality. The state cannot provide high-quality care for everyone. It is mathematically impossible. We will see a bifurcation: a private, robot-assisted, high-tech healthcare system for the wealthy, and a crumbling, rationed state system for everyone else. If you want to see our future, look at Japan today. Japan's demographic collapse started 30 years ago. Since then, their stock market went nowhere for 3 decades. Their debt exploded to 250% of GDP. They are a wealthy society, but a stagnant one. But there is a terrifying difference between Japan and the West. Japan got rich before it got old. China and parts of the West are getting old before they get rich. China's demographic crash is the fastest in history. They will lose nearly half their population by the end of the century. They do not have the social safety net to handle this. This is why the smart money is pulling capital out of China. You cannot invest in a country that is demographically dying. The Japaneseification of the global economy means lower growth, higher debt, and zombie markets. Unless we can invent a way out. So, is there any hope? Or is this just a slow march to extinction? There is one escape hatch: productivity. If we have fewer workers, each worker must become superhuman. This is why automation and AI are not job killers. They are economy savers. In a world of labor shortage, the robot is not the enemy. The robot is the only thing keeping the lights on. Japan knows this. That is why they are the leaders in robotics. They aren't building robots because it's cool. They are building them because they have no immigrants. The smart money is betting that the US will follow the same path. We will see humanoid robots, like Tesla's Optimus or Figure, deployed not to replace workers but to fill the empty shifts that humans refuse to take. Nursing homes, warehouses, construction sites. The investment thesis is simple: long the companies that build the labor force of the future. Finally, the smart money is looking at the ultimate asset: time itself. If we are going to live to 90 or 100, we cannot afford to be sick for the last 20 years. The current healthcare model is sick care. It treats you after you break. The new model is longevity, keeping you productive for longer. This is the new gold rush. Biotech companies like Eli Lilly and Novo Nordisk started with weight loss, GLP-1s, but they are moving into Alzheimer's, heart disease, and aging itself. The richest people on Earth, Bezos, Altman, Thiel, are pouring billions into life extension technology. They know that in a gray world, the most valuable product you can sell is another year of healthy life. This isn't science fiction anymore. It is the biggest sector of the S&P 500. Let's summarize the investigation. The silver tsunami is inevitable. The math is already written. The workforce is shrinking, and the liabilities are exploding. The smart money playbook is a hedge against this slow crash. 1. Short the pension promises. Do not rely on Social Security. Assume it will be means-tested or inflated away. Build your own safety net. 2. Long automation. Own the companies that build the robots and the AI. They are the only solution to the labor shortage. 3. Long healthcare and biotech. Demand for their products is guaranteed to double. 4. Avoid countries with terminal demographics. Stick to nations that can attract talent or automate fast enough to survive. The cradle is empty. The wheel is stopping. But for the investor who sees the shift, the gray wave is an ocean of opportunity. This is the smart money wisdoms. The future belongs to the owners.